Good. As we only have like 30 minutes today, maybe let's get started. Well, there might be still some people joining. So first of all, welcome everyone and welcome especially to you, Stefano, for today's webinar on how to future-proof your model risk management. Let me first maybe introduce Stefano, who is the Group Chief Risk Officer at Banca Mediolanum. Banca Mediolanum is a financial conglomerate, actually, including both an important asset management, insurance, and banking division. So over the next 30 minutes, I will be discussing with Stefano the main challenges and trends in model risk management, and then especially as well the impact of ECB reporting on model risk. And we will conclude the session with some learnings on how to future-proof your model risk management. Now, during the interview, feel free to put your questions in the chat. We will definitely address them at the end of the session. And I would also like to invite you for participating in a few polls that we are going to run during today's session to make it a bit more interactive. And so with this, let me maybe start off today. Stefano, can you maybe highlight a little bit what are, according to you, the key challenges and trends that you observe today in model risk management?
Sure. Good afternoon, everybody, and thank you, Jos, for your invitation and the opportunity to have this chat with you. I think it's. I'm not saying anything special when I say that we in banking, in insurance, in the financial sector, generally speaking, we use models pretty much everywhere. Okay, I'm responsible for risk management, and models are used across the board on all in order to manage all kind of risk that we face during our activity, being credit risk, being financial risk, being operational risk. So one of the main concern of of the regulator on one side, but of the management, the top management on the other side, is to make sure that when I implement a model in production and get out some numbers that I use to make for making, a management decision on a business, these numbers must be correct. And the only way to address this point is to make sure that you have a proper model risk management framework in place. Now, that's perhaps can hear to someone easier to say rather than done, but actually it's something that it's quite critical, quite important, because the numbers that you take out of your models are used for on a daily basis for making decision. Think about if I think about where we started when we decided to implement to start this journey together with Jos, with yields. We were at the beginning of the introduction of the IFRS 9 rules, accounting rules,
Yes.
which, by the way, are not just affecting the way you calculate your expected credit loss on your balance sheet, which by itself is already quite a critical and a strategic number, but it's also affecting the way you do credit risk management in your day-to-day business. Okay, so we were facing this sort of dilemma on how to properly to make sure that the models, the rating models implemented were going to be consistent with our expectation on one side and the rules imposed by IFRS 9 principle and the Bank of Italy on the regulatory side. So this is where we come from, and this is why we decided that we had to put a proper model risk management process in place, keeping an eye, and that's a key point, to efficiency, because it's easy to say, right, okay, I put in place a new office called model validation, okay, and I'll staff it with 10,000 of people, 100 of people. It doesn't work like that. You need to find the right balance between, head count that you dedicate to a task and the efficiency of the task at stake.
Mhm. Yes, exactly. And you mentioned a very interesting point, Stefano, about like ensuring consistency between models. This clearly requires like a good overview on all the models that are currently being used to just help guarantee indeed that somehow modeling approaches across the enterprise are actually kind of homogeneous. Is that something that you, as a chief risk officer of a large conglomerate like Banca Mediolanum, is that something that you actively monitor? For instance, the consistency between banking, insurance, and asset management models, for instance.
That's right, absolutely. As a financial conglomerate, we share models between different areas of business, especially between banking and insurance. To be honest with
Mhm.
you, and credit risk, counterparty risk is one example of that,
Mhm.
where we have implemented the same framework across the board. So we need to make sure that we are consistent in what we do on one side and on the other side, and the framework of model risk that we have implemented, the policy rules we have implemented,
Mhm.
ensure that we achieve this consistency.
Okay.
Now, I must be honest with you, technology is a key part of it.
Mhm.
Okay. So policy is important, but policy rules need to find a good, let me say, enabler. Okay. And technology, the way we see it, and is the way to enable these rules to be consistent across the board.
Mhm. Yes, exactly. And actually, to maybe continue a little bit on this theme of using technology. Um, so a few years ago, indeed, you made this decision to move towards a more technology-enabled way of managing your model risk. Now, of course, as a large organization, obviously, you have many resources at your disposal, and there is very often a kind of contentious decision that has to be made between either buying a vendor solution versus building something out internally that obviously comes with different cost structure over the lifetime of that product. Can you maybe comment like quick briefly about how in general you are making that trade-off?
Sure. Okay. I don't think there is a specific point, a specific trade-off. What you, I would rather say that a risk manager needs to be able to do the job of a risk manager, not
Mhm.
a data quality checker, rather than someone that has to control that things work properly. So, but on the other side, the new trend in risk management is to have people with degrees in mathematics, in statistics, in physics. Why? Because programming is a key component of being a risk manager today. It's not like when I graduated in business and economics, but that's not the kind of people I would hire today. Today I would hire people with mathematics, physics, and a statistical background. Now,
Exactly.
apart from the job, the thing is, of course, you can decide to buy an off-the-shelf solution, but you need to have people in the organization that are able to use the solution properly. You can't just expect, an external vendor to come up with something and say, here is the package, and it works by itself. It doesn't work like that. You need to have a certain type of expertise within your organization. And when I say organization, I tend within your team, okay,
Mhm.
to make sure that you're not over reliable on the vendor rather than or your IT department. Now, if I have to be honest with you, a solution which sits probably in the middle from my point of view is the kind of choice we made when we decided to join forces with you, because it is a package, but at the same time, it gives us the flexibility to use it the way we feel is more efficient to use it.
Yes, so basically to summarize, it's like you look for the infrastructure so that this
Exactly.
complexity is taken away, and then you can focus on the SME tasks. Your people can focus on their own SME tasks. Okay, that's indeed a very interesting view. Let's maybe quickly go to say another important theme, I would say, which is about regulatory inspections and exams connected to model risk management. We all know these are on the rise, and more regulatory requirements are being published. So what do you consider as, say, the top areas for where banks are making changes to be able to continuously align with supervisory guidance? Well, where do you think are the key points that need to be taken into account?
I think the wind is changing, and also at the European level, they're making a big effort. I'm talking about our main regulator to accept that technology is integral part of the day-to-day business life, and
Mm-hmm.
therefore it must be integral part of the model risk management process too. Why am I saying that? Because, as you know, we've implemented in our credit risk, but also the financial risk models, we have implemented as part of the overall framework an artificial intelligence process based on neural network, which basically, replicate almost autonomously a benchmark model, which we use to benchmark, the production model, and on which we execute all the set of tests that we execute on the production. Now, that's something that if we were to use that for regulatory purposes, so to calculate the regulatory capital, wouldn't be allowed at the moment,
Mm-hmm.
okay? So we are using for our economic capital, we're using for our, accounting processes, and that's fine. Now, the kind of thinking that we tend to see in the debate with the regulator at the moment is going in the direction of finding a way to address that transparency issue, which they perceive is still quite contentious, in order to be able to use these techniques and the artificial intelligence to make the process more efficient, because it's undoubtedly more efficient.
Yes, okay. So basically, to summarize, say somehow the peripheral tasks can more easily be taken over by machine learning, but then the actual regulatory models, you would probably still keep them more on the classical type of modeling for
It will
now
take some
to avoid.
time. It will take some time. I know because I'm talking obviously to you. I'm talking to other, technology companies, and there is a big debate going on at the moment in order to, improve transparency on one side, but on the other side, from on the regulator side, to accept that some tasks can be performed by machines, basically.
Mhm. Okay, perfect. So let's maybe then just launch a short poll to see to gather a little bit of intelligence, say, from the audience. So we would like to launch the following poll. So how many model risk management related regulatory exams has your institution undergone in the past 2 years? Say, so I'm quite curious to learn a little bit, and then we can maybe comment if this as we believe a kind of a statistical average or rather an outlier. So let's give the audience a few more seconds to make up their mind. Good. So let me end the poll now. Good. So it seems that the majority of the audience has around either one or between 2 and 5 exams over the past few years, as you can see probably now on the screen. So would you consider this like a typical sample, Stefano?
Yeah, it
Can you
doesn't
comment on
surprise
that?
me. It doesn't surprise me at all. Also because, as I said at the inception, at the beginning, we have models are so widespread across the organization, especially in risk management, that there will be many areas where regulator will want to check the way you use it, and now their performance are. I mean, think about credit scoring models. I mean, we're going towards even more towards, you know, a form of digital lending where, you know, everything happens without the human intervention. Okay, so those models, those credit scoring models, must be you know, absolutely performing properly all the time. Otherwise, you know, you tend to have your cost of risk skyrocketing, and you don't, without you even realizing it. Okay, so the regulator is very well, you know, aware of that, and it's aware of the trend, and is checking this type of usage and these performances on a regular basis.
Yes, exactly. Okay, and if you like elaborate a little bit further on that theme, so I learned, you told me actually, Stefano, that Banca Mediolanum is exceeding or will be exceeding this capital threshold of 30 billion euro, which means that there is going to be a direct reporting line to the ECB that is going to be established. So how does that in general impact your organization and then especially your model risk management practices?
We are going to find out over the next few months, but yes, it's official because it's on the accounting on the you know financials already published. So yes, we have exceeded at the end of the end of last year the 30 billion threshold of assets, 30 billion of assets threshold. So we are going to be supervised by ECB starting from 2022. So that means that we're going to have a new regulator, obviously, and a different probably interaction on every topics, and specifically for what today is concerned on the model risk management area. What are the key points here? Well, obviously, ECB is very let's say, puts a lot of attention on performance of models, as well as Bank of Italy does. But you know, the thing that you use, for example, your they're going to scrutinize very closely how we do it, and we're going to have to start this debate on the use, for example, of artificial intelligence in some of the steps, some of the processes of the model validation and the management of the model lifecycle that we do at the moment. And as I said, we know that because that's what you see on in literature and what you see, you know, in forums at the moment. There is a big debate about you know, trying to make this type of procedures more widespread, you know, across the board. So the regulator as well is aware that this type of you know technology and this type of processes are becoming common, you know, within medium and big banks.
Okay, yes, that's indeed true, and especially indeed with advanced analytics and AI, as you just mentioned, but probably, but would you also, for instance, expect, say, some more organizational or organizational changes as part of this transition towards direct ECB supervision? For instance, do you expect that you would organize the team slightly differently, a more strict separation between lines of defense, for instance? And related to that, do you believe that you need to kind of raise the awareness of model risk management in general across all lines of defense, given that it is more than just one validation per X amount of years, but rather like the responsibility of the entire enterprise, from model developers and model users over validators up to the auditors, the internal auditors themselves? Do you have certain initiatives that you think will have to be rolled out to increase that awareness, or is that already kind of clear for everyone within the group that this type of
I think from you raised a pretty good point, and um, if I remember from a previous experience when I was still working in London, I briefly worked for Standard Bank of South Africa, where I was in charge of developing the Basel II probability of default models for credit. And I remember that at the time, the internal audit department was staffed. They started to hire people with strong quantitative background in order to perform the independent validation. Now, here what we're saying now is that this is a kind of issues, a kind of thing that will have to, probably be addressed within our organization too, because at the moment, internal audit is quite happy with the way we are structured. I mean, there is a development team and there is a validation, team, which are clearly separated. Okay, but that will not be enough in the future. Probably we will need to have the third line of defense, so the internal audit, which will need to have quantitative skills, very much quantitative skills, in order to perform a further independent validation of what would be developed within risk.
Yes, exactly. And then indeed what we see is that the third line of defense, its main responsibility from a quantitative point of view is really to try to identify if there is any missing, if there is any risk factors or risk drivers that have not been properly identified, I guess, right? So
exactly. So the ideal situation will be a platform, and I guess we are already pretty much ready for that, where you share pretty much, there is full transparency. You share all the information on different layers, on different levels, so everyone can access what has been done, but deep down to the level of the code that has been written, rather than the data that is used for to perform the development on one side and the validation on the other. So
yes, exactly. So basically either a single platform or so a strongly integrated set of solutions that can support the entire model lifecycle. And this is indeed a general theme that we observe basically in any organization that matures in this model lifecycle management. Indeed, so we've been talking quite a bit about technology today. We wanted to actually launch another poll as well about the amount of investment in technological capabilities, and especially then in model risk management. So let's launch that poll as well to the audience. And so the question is indeed, where has your organization been focusing investments when it comes to model risk management solutions? Was it more in model inventory, either maybe in a workflow engine to help automate or structure certain business processes, maybe some quantitative tooling like compute infrastructure, for instance, or ways of building alternative models or benchmarks, or maybe cloud infrastructure, or of course others, or in the slightly more pessimistic case, no investments at all, which might mean that all the tools were already available. So let's give the audience indeed a few more seconds to respond. Good. Okay, so here as well, I think there is quite I would say a quite typical distribution again that we are observing. So clearly the model inventory is an extremely important tool when it comes to model risk management. You need to keep track of all the models that are being used. And then quantitative tooling, which kind of ties back to your previous remark, I think, Stefano, that with machine learning, advanced analytics on the rise, clearly you will need more quantitative tools as well to be able to manage that infrastructure. Any comments on this poll, Stefano?
Yeah, let me comment on this. I think one of the things I forgot to mention before is that when you ask me what is going to change, once we move to the ECB supervision, model inventory will become much more a priority. because they publish quite a number of papers where they explicitly said that they want model inventory processes and tools in place within the bank. So that's definitely something that we will need to address, because I can't really say at the moment we have something strong in that direction. But yeah, I agree with the outcome of the survey.
Okay, perfect. So as we are approaching the end of today's webinar, let's maybe ask the audience if there is any particular question. So feel free to put the questions in the chat. You can address the panelists directly, or if you prefer, I think you can share as well to all the attendees as well, or to Stefano personally, of course, if you wish to do so. Okay, let's see if there is any particular questions coming up. Okay, so there is already one question that I noticed. So to what extent, Stefano, do you believe that introducing new technology can actually be a driving force to attract the right talent? You mentioned earlier today that you need to hire like strongly quantitative people, and clearly these type of people, data scientists, for instance, they're obviously almost every company today is looking for that talent. So can you look at new technology as an enabler to help attracting the right people?
Very much so, actually. When we let me say something. Let me give you our experience, okay? When we completed this project with Yields, with yours, we also candidated this project to the within the Italian Banking Association, which does on a yearly basis a sort of a checks what the best innovation project that are taking place in banks, and we actually won. Okay, so that was that specific category was considered the most innovative project in Italy at the time. Which was indeed something quite innovative, okay? Because the platform we implemented and the way we use it was quite innovative at the time. But as I said before, it's not just the solution we decide to take at the time with Yields, but rather than I can mention other vendors that we use. Do not really imply that you take a package, here it is. It works on its own. No, you need to have very well prepared and very skilled people to enable this technology to work properly. Technology on itself, it doesn't solve your problems. Okay, you need to have within your organization talent, and unfortunately, I must say, with what is probably one of the few positive things of what has been going on over the past year is that the job market is not regional anymore. Okay, we had even before this pandemic struck, we had a good experience with Yields, because I remember one of the analysts came from the United States, and he probably did it because it was good at the time. The mindset at the time was he needs to be here in Italy with us, but once the project was finished, we kept on, doing video and address and writing codes with him, even from the distance. Now, today, that's not the exception. That's the standard rule, because we are forced to work in this way. In the future, when all this madness will be over, okay, we're gonna keep what the good things that the evolution that in a way that we achieved, so we're gonna have talent from Belgium, from the UK, from the US, from France, from wherever, that will be happy to, or potentially could be happy to work with us on a specific project or a specific task like the one of model risk management.
Okay, it's good to hear that the current situation actually brings some positive items as well. And maybe a last question, or I try to combine some of the questions together maybe. So we've discussed about introducing machine learning models. So obviously there is also clearly a hype around machine learning in general. It's not a silver bullet, of course. Can you maybe comment a little bit on its role in finance, and maybe as well like link back to the overall theme of today, which is to future-proof model risk management, which means
Yeah.
dealing with the future of modeling, but also using modern techniques to deal with model risk, basically.
Okay, I'll start from the end, and then I move to
Yes.
the first part of the question. I think what we've done was not to future proof, but we actually present proof, because, as I said, these models are in production. Okay, and what we do, in a nutshell, we have implemented a neural network which replicate, in a completely autonomous way. I mean, we give them the data lake, and we give them the output that needs to be generated. Then how it does it? It does it autonomously, and produce a benchmark model of our credit scoring model that we use for our IFRS 9 expected credit loss provision. Okay, now on the two models, the production one and the benchmark one, we execute all the set of statistical tests that needs to, tell us if the models are behaving properly. Okay, and perhaps it doesn't surprise, but most of the time, in many cases, the benchmark model has a performance which is equal, if not superior, to the production model. So the neural network is actually working very, very, very well on that. But it's not the only way we've used this technology. Okay, for example, in finance, there is one of the things that banks typically do is they model their sight deposit, because, as you said, as the word says, sight deposit are something that if you client go to the bank and decide to withdraw all your money, you are legally free to do it. Okay.
Yes.
But we know that we will never do that. Okay. That we normally stick to our bank account for many, many years. So that's the basic principle on which is based the asset and liability management of a bank. Okay, so I collect sight deposit, which are 1 day maturity, and I invest, I give mortgages and long-term financing to companies and so on. In order to do that, you model your sight deposit, okay, and don't want to be too technical, but the point is, you have to find the relationship between interest rate and stickiness. Okay. Now, since interest rates are in negative territory, that relationship broke. Okay, so we decided to use some behavioral patterns. Okay, to model behavioral patterns to see to derive a new relationship, and we use neural network to do that, because, as you can imagine, here we're not talking about modeling big data. We are talking about modeling huge amount of data and huge amount of relationship. So the only way, or the more efficient way to do that, it was in this way. But I can spend another, a few hours telling you all the other application that we think of implementing. For example, the digital lending I was mentioning before. We are developing some new model for our digital bank that we launched last year within the group, where the target market is the how is it called, the XYZ generation, the very, very young ones. So people that do not have a proper credit history. So you need to be able to model their social behavior, the way they use social network rather than the way they use their devices, the way they shop online and things like that. And we are already exploring these possibilities.
Okay, thank you to comment on this, Stefano. Just to summarize, machine learning is there. It's being used in production. It's being used to automate parts of model risk management to make that more efficient, as you said, like for benchmarking, probably for outlier detection, you can use those techniques to enrich the other statistical techniques that have been used for so long and that will continue to be used, of course, as well in the future. Good, and with that, I would like to thank you once again for participating in this webinar, Stefano. I thought I think it was a very interesting discussion, very topical, and I would also like, of course, to thank the audience for participating today. And I'm looking forward to continuing that conversation maybe next year, see how the ECB interaction is going. So thanks a lot.
Thank you very much.
Thanks, Stefano.
Have a good
Thanks,
day.
everyone.
Bye-bye. Ciao.